Welcome to episode 78 of the Crynet GenShow. I'm your host, and this week, the wait-and-see era is officially over. Because while traditional markets are, gasping for air under the weight of this massive oil shock, the crypto industry just received the ultimate green light.
Oh, it's completely night and day right now.
Right. We've seen this historic breakthrough on the Clarity Act with a bipartisan compromise that finally settles the whole stablecoin yield debate. I mean, this is the moment the floodgates for institutional payments truly open. Today, we are celebrating Bitcoin reclaiming $72,000, proving it can completely decouple from the S&P 500 when the world needs a hedge.
Yeah, and we're also diving into BlackRock's aggressive move to launch a staked ETH ETF, along with the technical secrets behind Ethereum's upcoming Glamsterdam upgrade.
Exactly. And we'll cover why 72% of global finance leaders now say crypto is no longer an option. It's just straight up table stakes. From the SEC's new asset mapping guidance to the $20 billion Kraken IPO rumors hitting this absolute fever pitch, the signal has never been clearer.
The rules are set, the tech is ready, and the capital is moving.
So let's break down the top 10. The data you brought in paints such a bizarre picture. Like, Bitcoin is at 72K, acting exactly like digital gold to hedge against all this macro chaos. But the fear and greed index has been stuck at 15 out of 100. Extreme fear for 39 straight days.
It's wild. It is a massive macro disconnect.
Yeah, it's like watching someone buy up all the umbrellas during a massive weeks-long drought just because they read the weather radar while everyone else is, just panicking about the dry dirt.
That umbrella analogy is, well, it perfectly captures the mechanics of smart money accumulation, because retail investors are paralyzed right now by scary headlines. But institutional funds, they operate on totally different time horizons. They look past the daily noise, they see the underlying structural shifts, and they quietly buy up the supply while the public just sits out.
Wait, let me push back on that for a second. If the fear index is at 15 and retail is panicking, how do we know institutions aren't just catching a falling knife? Like, what makes this a calculated smart money move and not just a really expensive gamble against a notoriously hostile SEC?
Well, that's the thing, because the regulatory fog is finally lifting. Your notes actually highlight the SEC's brand new asset mapping interpretation. For the first time, they have drawn a hard mathematical line separating what makes a digital asset a security versus a commodity.
Which officially ends their whole era of regulation by enforcement, right? The rules are finally actually written down.
Exactly. And that ties directly into the Clarity Act, the bipartisan compromise from Senators Tillis and also Brooks. It's a really pragmatic split. They banned passive yields on stablecoins, meaning you can't just earn interest simply for holding them in a wallet because, that mimics an unregistered security.
But
But they fully legalized transactional rewards.
which is a huge deal.
It really is. That distinction is crucial. It means if you are actively participating in the network, like routing payments or providing liquidity, you can be compensated for that work. It completely removes the existential legal threat for payment providers.
Basically telling the market you can build actual utility without waking up to a subpoena. So the legal guardrails are up and Wall Street is just flooding the zone. Looking at that Ripple study, 72% of global finance leaders now consider digital assets table stakes for 2026.
Right. They are entirely swapping over their infrastructure. We're seeing giants like JP Morgan and Citi bypass the whole concept of government-issued central bank digital currencies. Instead, they're issuing their own commercial deposit tokens to settle cross-border trades instantly on blockchain rails.
Oh, and BlackRock isn't just buying Bitcoin anymore. They filed for ETHB, right? That spot Ethereum ETF that actively passes those staking rewards directly back to shareholders.
Yeah, they did.
But wait, here is the mechanical problem. Wall Street generates millions of trades a second. If they dump that kind of institutional volume on a blockchain today, the network crashes and transaction fees just skyrocket. How is the underlying tech physically prepping for that load?
That is the exact problem Ethereum's June 2026 Glamsterdam upgrade solves. They are implementing something called parallel execution, while pushing the network's gas limit to 200 million.
Okay, to break that down for you, gas is just the computational effort required to process a transaction. So raising the limit means blocks can hold way more data. And parallel execution completely changes how that data is handled. Instead of processing one transaction at a time, like a single grocery store checkout line, parallel execution is like opening up 100 registers at once.
Yeah, and the net result is an 80% reduction in fees. So the technology is scaling at the precise moment the regulatory hurdles are dropping. And humans aren't the only ones taking advantage of this frictionless environment. Your sources show autonomous AI agents are already running pilot programs, executing independent machine-to-machine settlements using Bitcoin and USDC.
AI bots paying each other in crypto because traditional bank wires are too slow. That is wild. Between the Clarity Act, AI agent settlements, and commercial deposit tokens, the financial infrastructure of the 2030s is being wired right now, in March of 2026.
Absolutely. Whether it is AI agents choosing USDC for their trades or NASDAQ prepping for 247 tokenized stocks, the transition is absolute. We're even seeing rumors of a Kraken IPO targeting valuation over $20 billion.
Which is the ultimate signal that this market has matured. And honestly, that's a wrap for episode 78. What a week of resilience. Seeing the fear and greed index at 15 while Bitcoin sits above 72K tells us one thing. The smart money is quietly accumulating while the world is distracted by the headlines.
100%. It is a lot to process, but it is crucial to understand the foundation being laid here.
Definitely. You can find the full text of the SEC's new asset mapping guidance and the breakdown of the Glamsterdam specs in our show notes. If you are building in this space or just protecting your wealth, you are on the right side of history, but it leaves you with a pretty serious question to mull over. If AI bots and Wall Street banking giants are now treating digital assets as standard, unavoidable infrastructure, how long until holding traditional fiat becomes the actual financial risk? Stay sovereign, stay focused, and I'll see you in episode 79.